This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojasek from Trend Spider. We have a
breaking news. What is up, everybody? Happy Tuesday. Welcome back to another episode of Benzinga Live. We've got a packed show today. Here in a few minutes, my man David Green will be joining us. Dave Green will be live trading. We'll be looking at some options, some of the hot stocks that are moving, as well as just some overall market outlook with Dave. And then at 12:15 from TD Ameritrade, we will have on Alex Coffey, the senior trading strategist. So we'll see how people are, people with TD accounts, what they've been doing. And then at 12:30, we'll get a nice little update from my friend Options Mike. So all around packed show with guests today. Again, let's just take, a few minutes here real quick before Dave Green hops on to go over what's been going on in the overall market. A little bit of a leak today so far where it looks like the S&P 500 is just kind of moving a little lower. I don't know if there's any specific news or if it's just, the market's been so hot the past couple weeks that it's fair to assume that some people are ready there to kind of take some profit. So I'm going to go ahead and get my Benzinga Pro pulled up. And right now we're kind of in this mode too where like the market's trading sideways. Some days the rates are ticking up, the bond yields, and then that will bring the stocks down a little bit and vice versa. So this is what's silly to me. So major indices are lower after job openings came in below estimates and factory orders. Okay, I see. But these seem to be kind of contradicting because if the job openings came in below estimates. Okay, no, actually they're together. So basically those would both be indicative of a slowing economy, right? If there was the expectation there was going to be 1,000 job openings and there was only 500, okay, maybe companies are hiring at a slower pace, and also factory orders declined more than expected. So that's also showing that economic activity could be on the downturn. Now, maybe we're not in a bad news is good news market environment anymore, because I think a couple months ago, news like this would have caused the market to go higher because people would have thought, okay, now the Fed can't keep raising interest rates. And so I don't know. I mean, if those numbers were both on the other side showing a hot economy, the market could have been down again. Yeah, according to the CME Watch tool, we can get this pulled up real quick, showing now that there's more of a chance for no rate hike, which I don't know. I mean, this is just using like the bond market and other ways to predict this. But essentially yesterday they were saying 42 or 43% chance there was going to be no rate hike. Now they're saying 57. So you see those odds have jumped up just in one day based on that economic data that came out today. But again, the market doesn't seem to be loving it. I mean, like, again, you would think this was what happened to good news is bad news and bad news is good news. I don't know. But either way, the market clearly is saying here, okay, if the economy is slowing down, if we are heading towards some sort of a recession, then, the market's saying we're not so convinced the Fed's going to, right off the bat start cutting rates. It might take a few months. I'm not quite sure, but I see my man David Green hanging out backstage. It's been a couple weeks since we've had the pleasure of talking to Dave. So without further ado, let's go ahead and give my man DG, our very special Zinger Nation, welcome. And when we come back, we'll be doing some live trading with David Green.
Boom. What's up, Aaron? Mr. BZ.
What is up, my man? How you doing? How was that webinar a couple weeks ago?
Excellent. I think we had like 700 people or something. It was really nice.
Wow.
Thank you.
Do you guys know when the next one's going to be yet?
Promoting that for us. We are looking at, I think, where are we? April 19th. I think April 19th. Don't quote me on it, but I'll be back on before that.
Okie dokie.
I'll fill you in.
All right, Dave. What are we watching today? What are we trading?
I got no comments, Aaron. If you want to pop it up there.
Oh, okay.
Whatever.
Let me get you your chat box up. What are we trading today? What are we looking at?
What are we looking at? Well, when we walked in this morning, and by the way, for everybody that's here, we are now actively trading futures. We added that to our repertoire, Aaron. We're trading the E-minis and the MES, oil. So we started for those.
Man, stuff's above my pay grade.
You know what? It's for people who don't have that kind of cash in their accounts. You can trade the E-minis for a lot cheaper. And it's just like trading the SPYs. It's a little different, but it's like trading the spiders. And we're concentrating a lot more on options now for also the people who don't have the big money in their accounts, the less than the 25 grand. So we're trying to make it more accessible, not changing anything we do. We still use our technical analysis and everything, but we're trying to make it more accessible for a lot more people. And we've been getting a lot more people. We're actually putting together an options boot camp that we're going to do live on a weekend. And I don't know exactly when we're doing that either. But we walked in this morning. Am I sharing my charts? Yeah, I'm sharing my charts.
Yep.
And, you know, my thought process was I couldn't understand why we were up this morning, quite frankly. JP Morgan, what's his name? Diamond came out yesterday and kind of poo-pooed the financials and said we got a long way to go and things are in trouble and blah, 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 blah. So I couldn't understand why we were up this morning. So took a couple of little short positions at the beginning of the day, kind of rode them down a little bit. And now we're in nowhere's mode. So we're just keeping our eyes on some things, but it's very, 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 very quiet. What have you guys been up to? What's everybody in the room be up to? I miss you guys.
I don't know, guys. Tell Dave what you guys have been trading today. I know I saw some people earlier talking about some interesting trades they were putting on during the live trading show a little bit earlier. So
how'd that work out? Good for everybody, I hope.
I hope so.
We're looking at Tesla. I want to show you guys a couple of trends that set up today. That was pretty cool. Look at Tesla this morning, right? Spiked all the way up here, and from 9:30 basically, this stock has just been in a beautiful downtrend and gave us a shot to get in up here on a VWAP around 195, down $4 from there. So when we do find these good kind of trend trades that we're always looking for, we want to stay in them as long as possible. So we're looking from levels where we might want to buy Tesla. And if we go to our daily chart, guys and girls, which is always something that I like to look at closely. And here's the next level we're looking at. If you look at my 30 EMA down here, right on 189.55. So we got some bids out down there expecting a bounce if we get to that 189.55 level. And check this out. This was 3 days ago. All right. Yeah, I'm going to show you guys a trade we did in NVIDIA today. That was a very nice trader for us today. But look, this 3 days ago in Tesla. Look at this. Check this out, guys and girls. And for those of you who don't know, just real quick, we use a 9 EMA, 15, 30, 65, and 200. That's all the technical analysis we use. That's what we use to tell us where we might bite and short stocks. So if we go back a few weeks ago in Tesla, check out how it tested this 200 EMA. 2 days ago, it tested the 200 EMA. That was about 208. And look what we've done since then. So this set up for a really nice short opportunity for a couple of days, and we're down 17 points off that level. So everything we do in here, of course, Aaron, is always about technical analysis, using our moving averages. We did a little AI. I don't know if you guys are into this AI, right? Getting a little, check this out today. Check out this chart, Aaron. Is there any point where you would consider buying this from $35 to where it is right now?
No, that looks pretty ugly.
Right? So again, we try to catch these trend trades, and this right off the opening, a couple of spots when we broke this kind of consolidation here, and then big one when we broke this kind of consolidation here. So for everybody out there, I am never looking to buy a stock like this. I'm only looking to be short because there's no reason to be long this stock. A lot of people, you know, and if we go to the daily chart in this is AI. It's been one of the greatest things from sliced bread for a couple of days, right? We had 3 days in a row up from $24 to $35. We've given every single bit of that back, right? So now we're coming into a little daily support level at $24.50. That is where this all started, right? So that's our 30 EMA now. So that could be the first little spot I consider taking a shot in this thing, right around $24.50. But there has been no bounce in this stock. You know, we always look for, Aaron, sometimes when we get a below 20 RSI to start looking for that reversal. Look at this thing. It's had a below 20 RSI. It got down to about 4 right here. And we went from 26.50 to 27.30. It gave that one little dollar bounce. That was it. But it's had this RSI. Now it's back above it. So we're going to put a little order in. If we don't get a bounce off this level, 24.58. That could be a spot where we get a nice little bounce. It's down another dollar from here. So I'm going to show you guys. I'm going to put an actual order out. AI 24.58. Actually, if it holds that level, it could be a place to be a little aggressive. But we'll see. We always start out with like a half a lot, 50, 100 shares, and we'll add to it if it gets to that level and shows that it's going to hold that. NVIDIA, check out NVIDIA today, guys and girls. This was pretty cool earlier in the morning. So again, always looking for technical analysis. This stock went from 280 to 275, right? And check out what happened when we hit this pivot point down here. That was $275, and it got right to resistance at almost 278. So this was a nice $3 trade. Check this out. Everybody in the room know what a double bottom is? Give me some ones if you know what a double bottom is. Those of you who are watching. Stock makes a low. Goes up from there. Comes back. Tests that low again, which it exactly did, and gave another $1.50, $2 trade. This is what we call a double bottom. That is one of the first trades that most people learn because it's a pretty simple trade. Stock makes a low, goes up at least a buck, at least 30 minutes in between, goes back, hits this level. Boom,
I like looking for a good old double bottom there and just seeing where it's because when something bounces off the second bottom, you can feel here's what I like about it, Dave, is you have a very clear defined, like if you want to set a stop loss, like boom, that's right it. There where it bounced, and then if it breaks through it, okay, that's probably bearish. But if not, then hey, you've kind of got like essentially a risk-free trade out there.
Exactly. So, you know, normally in NVIDIA, if I'm doing a trade, I'll give it a buck or a $1.50. In this case, when we did the double bottom, I wouldn't have given that more than 50 cents. So it's a very low risk trade. And, you know, again, we don't sell. We always take a little profits on every single trade that we do. So I would definitely sell some up 50 cents, but wait for the resistance before you get out of the rest of your trade. One of the most important things, Aaron, I always talk about with all my traders and every webinar we do and everything else is getting the most out of your winning trades. And you guys tell me if I'm right or wrong. One of the biggest problems with traders is losing a lot of money on their bad trades and then not getting enough money out of their good trades, right? It's trade management, after you learn money management and psychology and everything else, is the most important part of trading. Everybody can pick the spots where you want to buy and sell. Not everybody, but a lot of people use technical analysis. Your charts tell you when you should do something to put the odds of that trade working in your favor. But what you do once you get in the trade is the most important thing. You know, so if I'm willing to risk 50 cents on this trade, well, I would have got 50 cents, $1, and $1.50. So, you know, that's almost a 2.5 to 1 ratio wins to loss. And that's what you have to have on most of your trades. And you guys in the room tell me, because I have this conversation with everybody, right? How many people are not getting enough out of their winning trades and losing too much on their losing trades? Give me a couple of twos out there. When we have a webinar with 700 people and I ask people this, I get about 600 twos, because that is probably the hardest thing to do when you're charting trading. You know, we want to run out of our winners right away and let our losers run forever. And it's the exact opposite of what we should be doing. So we're
I was just gonna say, I've noticed that with myself too, where I'll beat myself up by just, you know, because I'll get out of a winning trade after maybe like 10% or something, and then it'll run the options will run another 20%. I'll be like, oh my god, I should have held. But at the end of the day, you know, the old saying is true that you can't go broke taking profits, but you can go broke hanging on to those losses. You can go broke, you know, thinking, oh, this thing's got to come back eventually, or, you know, I'm short this stock and it keeps going up. I'm going to keep shorting it because it's got to go down eventually. You know, you run into trouble when you start doing stuff like that.
Yeah, it's like Peter always says, Tooch, when we do our webinars, you can be right for $1 and wrong for $20, especially in this market, right? So it's all about getting out of your losers quickly and letting your winners run as much as you can. And it is by far the hardest part, right? So I'm looking at the video now. It's starting to spike up a little bit. We got a 30 EMA at 277.20. Not enough movement for me to want to short that. But here's my 65 EMA and my 200 EMA, right around 278.15. So by using our technical analysis, guys and girls, it puts the odds in our favor of every trade we do working. Doesn't mean it's going to, but if I'm doing something and I can put the odds in my favor of that working, it's going to work more often than it doesn't. So we're going to put a little shorty up here. We'll call it 278.15 in the video. And this is what we're doing all day. We are looking for our trades, using our technical analysis, be very patient, be very disciplined, and wait for these opportunities to set up. Today's been a crappy day. We had a couple of good trades, and then we kind of just sitting around doing nothing. 270. And you know what? You tell me, and everybody in the room tell me. That has been the pattern this entire week, right? We've had an hour or two of trading in the morning, and then we kind of sit around looking at each other for the rest of the day. That's kind of how it's been for a couple of weeks now. Now, when we see something's not going to get to any one of our levels, we'll just cancel the orders. No sense in leaving them out there if something's not going to happen. AI bounced a little bit here too. MES is not getting there. The MES guys, just so you know, these are the E-mini futures. They basically follow the spiders, but they're much cheaper to trade. And we just use our technical analysis to trade these things too. It's the same thing we would any other stock. My favorite holding period is forever, Warren Buffett. Don, 100%. I mean, we're talking about trading. What we do is trade. Okay, we're day traders. We do some swing trading. We do some options trading. But we are day traders. That is our focus. So depending on the trade that we're looking to get in, you know, I look to make between 25 cents and a couple of bucks. Or when we find something that is in a nice trend, i.e. AI, I want to make multiple dollars off that. And Aaron brought up a good point for it. You know, I'm taking my profits too soon in some things. Well, here's the gig, though. If I'm getting in for a technical reason, Aaron, let it tell me where to get out for the same technical reason. You know, I have no resistance in this stock all the way up here until it hits my trend lines. So that's where I'm going to get out of the rest of my stock. If I'm getting in for a technical reason, there's no sense to get out of this for 25, 50, 75 cents. You know, the last part of our trade, I am making $1.70 on that trade. So whenever you get into a trade for a technical reason, always keep some of it and get out for a technical reason. That's how you're going to get the most out of your winners and lose the least out of your losers. Now, when this whole thing started, you know, we can talk a little long term for a minute. When we had COVID, I was screaming from the hilltops that this is a generational buying opportunity. We're going to bounce back from that. And we made new highs by the end of the year. When this whole thing started, I said, I think it's going to be at least mid-224 before we start making new highs on the market again. But will we, Donald? Yes, we absolutely will. And if you're young, Aaron's age, and everybody else is younger, I mean, you got to use these opportunities to be buying stocks, not selling, right? I mean, check out the video when this whole thing went down. This stock went to $108, right, Aaron? $108.
I mean, it's crazy looking back on now how much this thing got beat up.
Yeah, it is. But you want to see something really even insane? We had a support level down here. This is our 65 EMA on a monthly chart. And the stock went from $346 to $108. You don't think I'm going to start buying this to put away for an investment when the stock went down 240 points and actually hit a support level? You know, and if you started buying stock down there, well, look what you got. You got almost a 200% return in what? 1, 2, 3, 4, 5, 6 months. So all these stocks, the good ones. And when I say good ones, you know, buy stocks that make money for the long term. You know, I don't want to be buying Doku and BBBY and, you know, and stocks that just don't make any money. If we go back and look at some of these things, I mean, some of these things were insane, right? 314. I could show you a million of them, but what else? If you're a long-term investor, you buy good, solid companies that make money. And when you see opportunities like that, you don't run away from them. All right, everything's kind of smacking down a little bit here. Let's see if we got anything setting up. E-minis are coming in again. NVIDIA's coming in. So what do we like NVIDIA, guys? We're coming down from 214.60. We have a 200 EMA at 212.95. That's where we're going to be. In Meta. This is Meta. Meta's been one of the strongest stocks all day.
Wait, so Tesla's been super strong, but then we had that big move down yesterday with Tesla after the delivery numbers were pretty strong. How have you been looking at Tesla stock, David?
This is a perfect example of the numbers not meaning anything, Aaron. Right? So the delivery numbers came out. They were first of all, they were less than some analysts thought they were going to be. Yet they were strong. But it's all about price action, you know. And again, I'll go back to this daily chart. When they first came out, what was it, Monday, whatever this was, we had this giant rally up, got to resistance, and it's done nothing but pulled back from there. So I always tell everybody, it's price action. I don't give a shit, pardon my language, what the news is, what the earnings are. Just look at the price action in the stock, because if you were diving into this thing because you thought these deliveries were really great and everything, well, you're in a $12 hole already if you ran in and started buying it. So the only thing that matters, news, earnings, we're coming into earnings season in a couple of weeks, which I can't wait for. It's all price action. And I would much rather be, excuse me, reactive than proactive. And what I mean by that is I'm not jumping into anything. I'm going to let the charts tell me where it's going, especially on a shorter term basis. So
yeah, and it seems like that's the type of market we're in right now, because I mean, with the economic data we got this morning, some people probably would have thought the market would be up on that because it means the Fed might have to cut, more job openings than expected, or less job openings than expected. But yet the market was actually down on this news. So like you said, I mean, I think you got to put interpretation aside and just look at how the market's responding to these things.
Yes, especially if you're trading. Trading's a different animal. If we're talking about trading, just don't ever have an opinion. If you're trading, get yourself some good technicals that work for you. And look, we don't claim to have the holy grail. Get some good technicals that work for you. And more important than that is the psychology and the money management. If you're trading, if you're long term, you look to buy quality companies on the way down. That's the end of that story. Right? We have, I'll share a couple of positions we have right now. We have some FRC puts going out to next week. This is First Republic Bank. A couple of things we've been noticing. The bonds that they have been getting really beat up. Right now, they're paying about 20% on their bonds, which is not realistic. So this is something that we think might be the next shoe to drop in the next few weeks or so. So we have some puts in FRC, just lottery tickets that we're kind of hanging on to and watching. Aaron, did I tell you in the SIVB when that thing all went down?
You were in it?
We were very, very lucky.
Oh, it's not even loading for you. They took it off.
It's on the pink sheets. Here it is.
Oh.
When this started going down, we bought 70 puts, Aaron, for 20 cents. They went to $50. 20 cents to $50.
Holy cow. But you were able to sell the contracts before the...
Well, it was still trading. Yeah, it was still trading.
Okay.
It went down from 70, it went down to like $25 before the thing went away. So yeah, again, we didn't make $50. I think we sold it at like, I don't know, 17 and 25, but from 20 cents, it was still a pretty good trade. And that's why my mindset is kind of that in this First Republic also. So we'll see what happens. No, that was just you know what that was? It was a lottery ticket. That's all it was. And we'll do that from time. That's what I have in this now. It's a lottery ticket. If it happens, great. If it don't happen, I'm going to lose $100 or $200. But I like the odds of doing those things. NFTG. So this is what I was just talking about to know, right? It's a lottery ticket. It's a $2 stock. You know your downside. I always tell people, if you want to have, a small portion of your portfolio in some of these stocks, you never know. You wake up one day, boom, chakalaka. It could open at $10, right? It happened in a couple of things. I don't remember what they were. BFAI. Today, I think this one did. Right? What was that one?
Which stock are we looking at right now, Dave?
Bullfrog happened today. This stock was $2 3 days ago. Went to $9.50 today. And then, of course, got the absolute smackdown. I was looking at NFTG for the note. So when I look for these things, I'll look first. I think I'll look to see if they have options, right? NFTG. Some do, some don't. No options. So that's just a lottery ticket. If you buy the stock, you hold on to it. Meta dropping. Hold on. All right. I still like Meta on the 200, guys. If we get there in short order, we're bidding. The video, we're not going to get the short. Let's see what AI is. Nah, that's not going to happen before lunch, too. So whenever we put an order out in the stock, too, guys, speed is mega, 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 mega important. I want this to get to my 200 EMA as quickly as possible because that will give us the best odds of this thing bouncing from there. And, you know, we'll have room from 212 to 212.90 back up to like, I don't know, 214. Maybe we get 50 cents in a dollar out of the trade. And when you're trading like this, the idea is to get to the point where you can trade some size and then you only need 1 or 2 trades a day. You know, I have some people in the room that'll buy a couple of thousand shares here. And if you make 50 cents on it, you're taking $1,000 out of the trade. So that's what we're looking for. Spies coming in still. Yep, making new lows in the spiders now. So
yeah, the only thing that I'm looking at right now that's going up, go figure, is Tesla.
Tesla has a mind of its own. It never trades with the frickin' market.
I know it makes it difficult to trade, but it also makes it fun to trade for a lot of people. And it's I don't know. I mean, you see the Qs going down, you see the spies coming down, and think, okay, Tesla's got to come down too, right?
Yeah.
Not necessarily. This thing, keeps going up sometimes, and that's how people get caught in it, as they think, oh my God, there's no way this thing can keep going up from here or whatever, and it does, and that just shows you how, I guess, cruel and hard the markets can be. It's like, you think it's so logical, chart-wise, fundamental-wise, it has to come down, and then sometimes it doesn't because people are buying it.
Yeah, we still got Meta out right here, guys. Let's see if we get the Smackadaka right now. The longer something takes to get to one of my levels, the less apt I'm going to want to buy it. But we're spiking down. We got 7 red bars in a row. Let's see if we can get there in the next minute or two. And then below that, we got this 211.62. And the beautiful thing about trading, guys and girls, for everybody is I'm not forced into doing this. I'm going to give it another minute or two, see if it hits that level. And if it doesn't, I can't. I rather miss trades than lose money in trades. So let's check out the spies. I'm sure we're still going down here. Yeah, I'm kind of just sitting now. So if we see if we get the meta in the next minute or two. And look, gold. Look at gold, right? Gold's been ripping up. Look at gold on a daily chart. We're actually this is probably day 1, but if we get a couple of another big days up in gold, I'll be looking to do a little shortsky-wartsky if we get stretched out in that. I got nothing to sell, Aaron. What I will do is what I always do for everybody. You want to post my email. Anyone who wants to come out with us, come hang out in the live trading room for 5 days.
dgreen927 at yahoo.com. I'm putting it in the chat right now. I'm going to pop it up on the screen. dgreen927 again. Yeah, go pop it in Dave's room.
Yeah, guys, if you want to come hang out, 5 days, no charge. Hang out, watch us trade the markets live. We do a morning meeting every day, and we're trading in real time. Although everybody pushes their buttons, yada yada yada. Yeah, come in. We have some fun also. All right, let's see if we get meta in the next minute or two here. Come on.
So wait, just to clear, you're going long meta when it hits a level down. What was the level again?
212.95. That's our 200 EMA.
And then what kind of? I mean, we just talked about letting the winners run longer and cutting losers quickly. Like what would be your price target on the upside if you end up?
If I get 212.95, I will sell half of my trade for 50 cents if it bounces up, and then see if I can get the rest of it to go all the way up to the resistance level. That would be my game plan.
There you go. All right, folks.
We just got in. So you see we're long at 212.95. So we'll put an order at 213.35 if we go in that direction. All right, guys and girls, it's been my pleasure. Always is. hang out with you guys.
It's our pleasure, Dave, to have you come on and hear some of your wisdom that you're giving us. Again, the email's in the chat, dgreen927 at yahoo.com if you want to go check out Dave's room.
Thank you, man. We'll definitely check in next week. All right, my friend.
Let's do it. All right, y'all. That's DG again, Wall Street Global Trading Academy, or dgreen927 yahoo.com. Dave, have a good rest of your week. We'll chat next week.
Always a pleasure.
All righty, y'all. It is 12:08 p.m. and yeah, the markets are just kind of leaking here. Not sure exactly what's going on. Checking out. Okay, wow. Looking at CME's watch tool. We looked at this earlier today. The percentages, and again, this is just they're using like the live data from the bond markets to see what the odds are of the next Fed hike. But this is going up now that it's saying that there's going to be no rate hike. See, the current rate is 475 to 500. And right now they're saying 62% that we stay there after the next FOMC meeting. Again, that will be May 3rd. So about a month away. Interesting there. I mean, I wonder if that's just the bond market reacting here or what's going on there. But markets still continuing to leak here. I see our next guest hanging out backstage, but we got about 5 more minutes till that is scheduled. We're going to be talking to Alex Coffey, the senior trading strategist at TD Ameritrade. Excited for that one to talk about kind of what's going on at TD, see how some users over there are trading these markets. Let's just go ahead and pull our Benzinga Pro back up, and we'll go through some of the top stocks that people are watching today. And we also have some top kind of headlines from yesterday and over the weekend to go over as well. The big news, or one of the big headlines, was Jamie Dimon kind of continuing to talk about this banking crisis, which of course I've talked about before. It's kind of not, I don't want to say funny hearing him talk about this stuff, because obviously he probably is like the go-to banking expert, but like, of course he has a motive to say, regional banks are in trouble, right? Because JP Morgan is a clear beneficiary of when a company decides, hey, you know what, we're going to pull our money out of so-and-so regional bank, and let's bring it to one of the big boys. Let's bring it to JP Morgan. They're a little bit safer. So if you're Jamie Dimon, like, and you're kind of in this more cutthroat environment than you were a couple years ago when interest rates were at 0, and then you're trying to make some money, like, of course you'd be trying to say, yeah, like those banks are in trouble, come with us. So I don't know how much I really take away from that. I mean, I think he's, again, I don't think it's 100% like he's just trying to get some more money at JP Morgan, but I don't think it's also 100% just his like objective opinion. Like, I think he's probably trying a little bit to sensationalize how, because we brought Tim Melvin on, who's our regional banking expert, and he laid it out for us like plain and clear what happened with Silicon Valley Bank and how that situation was a little bit different than most a different situation for Silicon Valley Bank than what most regional banks are in throughout the country. So to say because this happened to SVB means we have to pull our money out of FRC or CFR or some of these other banks, he was saying was kind of silly. So I've kind of held the position that I thought a lot of the banking fears were overblown in general. So I don't really think any differently just because Jamie Dimon over at JP Morgan is saying, there's some more trouble ahead. I mean, I think the bottom line is what happened with SVB, where they had this hole in the balance sheet grow as interest rates rose. Most banks are hedging against that sort of, protecting themselves from having that big hole in the balance sheet. That's not to say that there aren't banks that, are financially a little bit in trouble here because of how high interest rates are gone and if they've bought a bunch of securities when interest rates were lower. But again, SVB had problems that were specific to that bank and the industry that bank serves. And if you're looking at regional banks across the country that are serving other industries, then they should be in a lot better position here. All right, let's flip through. Just looks like we're getting a little bit of bounce on the cues here. Again, we're looking at the 2-minute chart. You can see we were basically in a free fall. Q's got up as high as 322 earlier this morning before the market opened, now down at around 318. So Looking at the 2-minute chart here, if you're trading this, I'd be watching to see if we get down to this level right here where we clearly have some support going back to yesterday. But if we go back to a 10-minute chart and look at this at a little bit of a further, a wider view, you can see. So and I'm not bearish right now, but I wouldn't be surprised, again, because the markets have been so hot the past couple weeks, just if there are people out there taking profits. And something looking at a chart here, and again, we're looking at the 10-minute chart, so take what you will away from this, but looks like we kind of ran into a wall up here, kind of ran out of some steam, right? You made new highs, 321. And I like playing the markets when, striking when the iron's hot. So when Qs are hot or when the SPY is hot and it's ripping and you're making new highs and then it keeps going, like those are good markets to trade. When you start rolling over like this and showing that, okay, you don't have as much buying activity as you did, then I start to get a little bit wary. I start to, wonder like if most of that move has been baked out. So looking around at different stocks, even I was just talking about with David Green that Tesla was one of the ones that was holding up. Now looking at Tesla on the 2-minute chart, even Tesla's rolling over a little bit. Going back to Meta, Dave, of course, got filled there, and then he got that big spike up he was looking for, so he probably took some profits there as Meta came and spiked back up. I don't know if anyone in the chat out there followed him in on that trade. NVIDIA, this is one of those stocks that, just look at this on a weekly chart. This stock has gone from, basically $100 to $280, and looking at it on a weekly chart, like you got to expect at some point some people come in here and sell and take some profits. And I love NVIDIA. Price tells you the banks were not hedged properly. I mean, right. I agree, Jay Rice, that, you look at, say a weekly chart of FRC, or let's just look at KRE, the ETF. You can see, obviously, this huge down leg. But, and my point, and that's what I'm trying to say, is I'm not trying to say like, oh, everything's, hunky-dory, fine and dandy. But do I think that SVB's collapse and the following or the subsequent, fears and whatever was indicative or signaling like an '08 type financial crash? And I was, here on the show on record basically saying no. Like, you can go on Twitter and see all these people who, are now all of a sudden banking experts telling you exactly why this means the sky is falling. And here's why that might not be true. Here's why it might not be as big of a deal as some people are making it out to be. Not that it's not a big deal, because I understand it is. But with that said, I was willing to kind of take a stab at some of these banks, your Western Alliances, your FRCs, that aren't really in the same position as SVB was. CFR has been one of my favorites to be buying down here on the dip. Colin Frost Bankers. This is one located down in San Antonio, I believe, and does a lot of work with like Texas energy companies and oil and gas companies and all this stuff. And it's like, all right, like obviously the clientele that Colin Frost Bankers is serving is about as different as you can get than these high tech, growth startups that Silicon Valley Bank was serving. And one of those groups of clientele, the high tech growth, growth startups and stuff, are going to run into a lot more trouble in a high interest rate environment. So that's why SVB was getting a lot more withdrawal pressure than other banks. And I just don't see, Colin Frost Bankers, who's again serving these like energy companies and other companies down in Texas, getting that same sort of withdrawal pressure. So for that reason, it was enough for me to get in and buy some of these. And what I like about going down and buying some of these bank stocks on the dip is not only do you have the chance that the stocks just appreciate because they're trading below book value, but they also pay a nice dividend. So when you have a stock that's appreciating in value and also paying a nice dividend, that's a good that's a good bet for me. Yeah, Schwab too. I mean, Schwab got beat up, and again, like, do I think there are problems there? Yeah, of course. The market's clearly showing that. Do I think that means the bank's going to collapse or we're going to see some '07, '08 type thing? No, personally, I don't. So I'm willing to put my money where my mouth is in that sense and buy these stocks down there. Again, not because I think everything is perfect. If I thought everything was perfect with these banks and they're trading down, 20, 30% or whatever it is, I would be putting everything I have into them, which I'm not. I'm just buying some of those stocks. So with a percentage of my portfolio. But all right, enough about the banks. That's what I'm missing in my life is some dividends. Yeah, especially right now with like higher interest rates and the stock returns have been kind of muted the past year or so. Like having some nice divvies is not a bad way to go. But alrighty, y'all. I see our next guest hanging out backstage. We've got Alex Coffey, the senior trading strategist with TD Ameritrade. Without further ado, let's go ahead and give Alex one of our very special Zinger Nation welcomes and see what Alex has been what's top of mind for Alex. Alrighty, Alex, welcome to Benzinga Live. How are you doing?
Doing good, man. Thanks for having me.
Of course. Thanks for coming on. So you're with TD Ameritrade. Before we get started, why don't you tell our audience a little bit about what you do, what your role is at TD?
Yeah. First off, thanks again for taking the time and having me on your show. But like you, I'm fortunate enough to follow financial markets and comment on them and do stuff both for internal media, external media, and get to do something I love to do on a daily basis, which is try to make sense of the craziness that is the financial markets and the world surrounding it.
Got it. Yeah. I mean, so I don't need to tell you essentially that this year has been kind of wild in terms of different storylines and what's been going on with the market. Certainly an interesting time, and everyone has their take. Let's start with just general market overview. I mean, with interest rates where they're at, what for you personally, like, is this a buying opportunity for you? Is this something that you're kind of or worried about where stock prices are and that we could be making a move lower soon?
So while I'll refrain from telling you exactly maybe how I feel one way or another, I'll set the stage here. Maybe you can garner some of my thoughts from that. I think that the market is in a bit of a quagmire, a paradox, a catch-22, if you will, in the sense that we've been conditioned over the last few years. And I heard at the top of your show, you were talking about all the different maybe new market participants that came in during COVID and during the meme stocks that maybe haven't seen all the different market environments that have happened throughout history. And I mean, none of us have, but the most recent situation where we had the Federal Reserve, kind of quickly adjust rates lower, come in and provide liquidity, it worked. It coincided pretty quickly with the turnaround of March 2020 being the bottom. And a pretty nice bull market unfolded then after. However, if you go a little bit further back in time, 2008, .com, the Fed was cutting rates, and you still saw the markets go significantly lower from there. And so, while initially I think these rumblings of inflation, maybe this is the beginning of the year being towards its end, its peak, we're working towards disinflation. The Fed will be able to stop then. All of that is icing on the cake then for the market was the initial thought process, I think. And the thought then being, then the Fed is not in our way. The market's going to bounce back here. But, I think that could be misguided. And I think that we could be facing a situation where that soft landing, which in many ways is the new transitory, becomes increasingly hard to rationalize.
Yeah, and I think that's what's been really tough, I think, for a lot of even seasoned investors or just economists commenting on the market this year is that, things have been, I guess, like a little bit out of the textbook in terms of like you had inflation falling at the same time that unemployment was falling, and people were like, what? Like, how is this possible? And I think that, got a lot of people excited about the idea of a soft landing, but then now as the months drag on and inflation is still kind of hovering above the target rates and you have some indications that maybe some economic activity is slowing down, like you said, that kind of dream of a soft landing is starting to look a little bit more impossible at this point. So it'll be interesting to see kind of going from here which side the Fed is willing to tolerate more. Are they willing to tolerate inflation being a little bit higher, or are they willing to tolerate, unemployment dipping more in order to get inflation down to that point. So I think a lot of people are kind of basing their market outlooks on that. And that's basically how it's gone, is we've basically been talking about the Fed now for more than a year. And it's going to be, the market is going to be dependent on what the Fed does. It's no secret.
Yeah, I think that's a good point. I think that also brings in a couple interesting pieces when you're making decisions as a self-directed investor or where you want to allocate capital. Well, one, just the fact that interest rates are off the floor now, you have more choices. And so for the better part of a decade, as investors, we're kind of forced into an equity-only market. In the sense that, you wanted to get some sort of income stream. Maybe you go to some of the dividend payers like you were talking about before you brought me in. Maybe if you wanted to go out on that risk spectrum a little bit, you went to some of the non-profitable growth tech to get some sort of a return. And that all kind of naturally suppresses volatility. It's why in 2017 we had, a volatility index that was spending time below the 10. It was single digits for a little while. Where it's really hard to envision that now, given that there's just more competition for your capital. You could literally just park your money in T-bills for 4 weeks at a time, 8 weeks at a time, roll those over, and if rates just kind of stay where they're at, you're getting like 4.5% right now. So that's just very, very different in terms of market environment. So I think that's the first thing to acknowledge. Just that changes things, and then going from there. The system is obviously in an interesting point because, I know you had some comments on the banks, and I think everyone has their opinions. I don't think anyone's super surprised that some of the banks that were stressed, at least globally, is like the Credit Suisses of the world or the Deutsche Banks, and we've been reading about that for years. But my big thing is why suddenly now is the time that there had to be this emergency merger between Credit Suisse and UBS and the kind of knock-on effects of that. So yeah, it's obviously it's the news headlines or the banks being stressed and some of them failing. But for me, it's more of why now, and then what are the knock-on effects? Obviously, probably going to see credit tightening pretty significantly. But the reason we're starting to see quote unquote, price cuts being priced into the market, and you pulled up the CME Fed Watch tool, it's not necessarily that it's this guarantee we're going to have lower rates. It's more that there's really big money participants, some of the biggest in the world, that are hedging through euro dollars and Fed funds futures, basically saying that there's going to be economic hardship in the future, and it's going to be potentially in the short term.
Yeah, and that's a good point, Alex, that you bring up, just about having the interest rates off the floor, and it gives people, not just retail investors, but institutional investors too, more options out there other than just buying stocks and buying equities, which is basically like all you had to do and what you needed to do when interest rates were at zero in order to make a return. But so I'm curious just about, since obviously TD Ameritrade has, I don't know how many, I'm sure millions, hundreds of thousands of investors, retail investors that have accounts and have trading accounts. But I mean, most people don't, I guess, have the time, or they're not, day in and day out watching the market, seeing what's going on with interest rates, knowing when the Fed may or may not cut. So is it like to me, like it would seem almost too hard for an individual investor to okay, I'm going to buy T-bills now because interest rates are higher. Then I'm going to sell them and buy stocks once the Fed starts cut. Whereas would the returns really be all that different if they just kept buying stocks and didn't even look at it in the long run?
Yeah, I think it's a good question. I think it comes down to, the risk. So obviously there's always potentially greater reward for an equity investment. That's why you would do it. It's essentially, the credit risk is essentially zero for U.S. Treasuries. Of course, it always is possible that the U.S. government would default on those, but hasn't happened, and I don't think anybody's predicting that in the near term. So it's more of the foregoing of that risk if you're willing to hold it to maturity. But what I would say is, as retail clients, and I consider myself a retail trader, as I'm sure you consider yourself as well. I know your show is targeting that audience. Things like Thinkorswim, of course, the platform that TD Ameritrade has for traders, the education stuff that TD Ameritrade offers, as well as what you're doing here on Benzinga Live. All of this empowers the self-directed investor. So yeah, while it's a lot to, admittedly to unpack and explore and to think about, not everyone is as fortunate as you or I to maybe do this for a living full time. But there's plenty of stuff available to help make it easier. And things have never been more efficient and easier. Click of a button, you can now be an investor in XYZ stock, where before you maybe had to call a broker, yada, yada, yada. And so I think that's one big thing. But to provide some context maybe about how retail investors are kind of faring, or where we set up here, because a lot has changed in the month of March. TD Ameritrade publishes an investor movement index every month. That'll be coming out next Monday in terms of what actually changed in March. So I don't have the most up-to-date figures, but I can set the stage for you of what we were looking like going in to the month of March. Things were pretty grim in terms of investor sentiment, risk appetite to close the year last year. Lowest basically since March, April of 2020. But they bottomed out. We actually saw 2 consecutive months of that risk sentiment start to increase. And we actually saw net buying activity amongst equities in the month of February. So again, March may have completely changed that, threw a bit of a wrench into that trend. But we're actually starting to see equity excitement again and risk sentiment start to get up off the mat, alongside the fact that the market itself started to do the same.
Yeah, and I think it's interesting always looking at the sentiment of retail investors. Of course, there's a survey that I pull up from AAII that comes out weekly on Thursdays. But what I find like interesting about looking at it is it often just tracks price, right? Like price helps determine sentiment. So when like stocks are going up a bunch, people get more bullish, and the opposite is true too. So I was looking at this just the other day, Alex, and still, even last week, as the markets have recovered a bunch, there's still double the amount of bears, right? 45% of respondents compared to the bulls, 22.5. So there's still 2 times the amount of bears. And I wanted to mention too, like you're making the point about basically having the risk-free option of, that the T-bills offer right now. And I think it's interesting because even for someone like my mom reached out to me and she was like, "Hey, Aaron, can you help me? Like, I want to buy some, essentially bonds or T-bills with like interest rates so high." And it was funny because like 2 years ago, she was asking me, "Hey, can you help me set up a brokerage account to buy stocks?" Like, she just wants to know how to do whatever's hot at the time. But the way I'm thinking about it, and I know you might not be able to give some color on this, but it's like, if interest rates get to a point where they're high enough to where people like my mom want to like sell equities and buy those bonds, that's when I think like would be a good time to actually buy the equities, right? Because people are then going to start selling stocks to buy these bonds. And what happens when people sell stocks? Well, the price of those stocks go down. And then like historically, like I bet looking at it, though, that's actually a good time to buy stock. I don't have that data right in front of me, but I'd venture to say, like, I've seen that data before, that like when interest rates are higher is actually like what the time you want to be buying stocks. So that's why I think for like some retail investors, it's probably easier to just like, yeah, I'm going to keep my, bi-weekly investment into the S&P 500 and just let it keep going. And it obviously depends on how old you are, right? Like someone who might be like more our age, like younger, might have that flexibility, have that freedom to just keep adding to those positions, where someone maybe closer to retirement maybe won't be, able to just say, hey, I'm just going to keep adding here and hope everything turns out okay.
Yeah, I mean, there's a lot there, and I think that a lot of that sentiment, I mean, makes a ton of sense to me. I mean, anything that's jumping the shark or seems like the popular thing typically isn't necessarily the best road to travel in financial when we're talking about financial markets. What I would add to this is sometimes I think we get caught up, and especially as market commentators, we really get caught up in, is this bullish? Is this bearish? Is now the time to do this? Is now not the time to do this? Like, in reality, things don't have to be a one size all in, all out kind of a scenario. So I think of it, and this is sort of, playing it down the middle here, but maybe you take a chunk of your capital that you aren't using was in cash, and now you feel more comfortable, parking that in T-bills or something for a little bit longer because there's actually a return and an incentive to do so. But that doesn't mean that every single dime you have is suddenly no longer looking to take risk and is, hiding in the bunker because the curve on treasuries is inverted and there's a bunch of hedging activity in Eurodollar futures and there's talks of recession. I mean, I don't think that's the time either. Some of the best times to buy are when the fear is the highest. So I think it just comes down to, like you said, time frame, risk tolerance, what you're looking to get out of an investment. And I think anytime you can just have a plan, both for entry and exit, starting there is most important.
Yeah, so Alex, something I'm curious about, and we're kind of running out on the clock here, so this could be the last one. But what does it look like just buying for TD Ameritrade, like retail investors that have broker or portfolios with TD Ameritrade? Like what does the process look like for buying T-bills? Is it easiest to do that through like a treasury ETF, or how does that work at TD Ameritrade?
Yeah, so obviously there's tons of bond funds and things that you can do to invest in. We all kind of know some of those. I won't say any specifics because I don't want to suggest any, but those are more speculation on price, I would say. So if you're investing in a bond fund, you're more speculating on the directions of bonds. We actually offer direct access to new issues from the U.S. Treasury or secondary markets of Treasury bills, and that's all available through the tdameritrade.com website. You can go through there. I believe it's underneath the trade tab. There's a whole fixed income section. Pretty straightforward, I would say, if I could figure it out. But what I will say too is we got round the clock teams that know how to help you. If you got questions, just feel free to call those trade desks, and they'll be able to steer you in the right direction too. But I think TD Ameritrade's goal is just to give as much information as possible, provide as much access as possible, so that the individual self-directed investor is empowered to make the decisions they want to make, and ultimately make decisions that they feel be accretive to their long-term goals.
Got it. Then Alex, the last question I guess I'll ask is just about overall retail trading activity. You mentioned kind of those positive inflows coming in February. Like, what about just total amount of like trading volume? How has that held up as the markets have kind of turned down a little bit?
Yeah, like you said, in terms of the surveys that you'll see in terms of how the sentiment is feeling, oftentimes mirrors the market. Trading volumes that you'll see at brokerage firms largely just kind of track the overall volumes you see for the overall market. And so oftentimes when you see obviously shakier times, those are the heavier volume days. So when we had a couple periods of volatility in March, you did see some pretty hefty volume days, but for the most part, it's sort of normalized here. Some of those fears have dissipated. Like I said, for an update on sort of the actual behavioral impact, the kind of the names that were bought, names that were sold, how much risk appetite changed. Monday we'll be having that update, so that'll be able to provide some clarity on that front too.
Got it. Well, Alex, thank you again for joining Benzinga Live today. It was great to have you. Hope we get to have you on again. And if you guys ever have some updates, any exciting news to share with us from TD Ameritrade, of course, we'd love to have you on as well.
Of course. Thanks for having me.
Yep. Enjoy the rest of your Tuesday. All right, guys, that was Alex Coffey, the senior trading strategist at TD Ameritrade. I see our next guest, Options Mike, hanging out backstage, and we're a few minutes behind. So let's just keep it ripping, keep it tipping. Let's hit that intro for my man, Options Mike. Options Mike, how's it going? Happy Tuesday.
Happy Tuesday, AB. How you guys doing?
I am good. Just, I don't know. I'm like, I feel like I don't know what I'm doing right now. I feel like I'm trading for the first time ever.
Well, that's not good. Maybe
I know, right?
Right now, we should just all stop trading. We should just all go home and go to sleep.
But you know what it is? You know what I think it is? I think it's sometimes it's one of those things where when you're like getting better at something, I'm going through this a lot right now in other aspects, but like people I think that like progress in whatever skill, whatever you are, is like a linear line. And I think sometimes you like run into some, I don't know. Sometimes I feel like I even like regret, like say like golf, for example, I'm like getting better and better and better at golf. And then all of a sudden, like I'll regress and be like shooting worse than I was shooting a couple weeks ago and think like, oh my God, how is this happening? And then I realize like, okay, well, let's go back to when I was doing this better and that better. And then you a little bit more. Yeah. And then you like, you think I just need to drink more?
Here you go.
No, but you know what I mean? And then I feel like for trading, I'm like, what am I doing? Why did I do that? That's something I would have done when I first started trading, and now that I'm thinking about it, I'm like going to end up getting better in the long run.
We all have that. I mean, nothing goes straight up or straight down, right? We always have these dips and you have these pullbacks to get into. Trading's the same way. I mean, I took a loss on Tesla this morning. I broke one of my rules I always use on the first 5 minutes. Never trade until it takes out the opening 5-minute candle. I jumped on calls before it took it out, and guess what? Got burned on it because I didn't wait. So, we all get in those times and we do things we shouldn't do. It happens, right? We just have to push on and say, okay, I went out and I traded snow a couple of times and traded the ES and made my money back, and then a whole bunch more. So sometimes you just have to look at things and say, broke my own rule, did something stupid, and just kind of move on and say, all right, plenty of time left in the day.
Yep. What have you been trading the past couple weeks? Anything exciting?
Today was snow and Tesla didn't go so well.
Tesla. I was talking about Tesla earlier. It just was moving like opposite of how the overall market was moving. Like the market was dipping and Tesla was going up. It was like, of course, this thing has a mind of its own.
I've been in and out of a lot of things. I was in and out of IBM, Micron, McDonald's, Oxy, Shop, Amazon, ON, Square, AMD, Boeing. So I've been trading a little bit of everything here and there. Whatever looks strongest, whatever seems to be in play, that's kind of where I've been taking my trading right now in this market.
Got it. Well, let me go ahead and pop up your charts, and we'll go ahead and rip through some of them and just show us what what you're looking at chart wise.
So, for me today was overdue. And, a lot of people are out there saying, okay, this is this beginning. I see people saying, this is the start of again. Here we go. We're going to go back to the October lows. And I like deep breath. We came into a market. This was the fifth day in a row we gapped up. That is a painful trade. We were well out of the Bollinger Bands. We were 10 handles off the 8-day, and the oscillator, some of the stuff I follow said the market had gotten short-term high. So we knew coming into today was tough, but we also know it's a holiday week. And, it's a short week. It's only 4 days. The markets are closed in observance of Good Friday on Friday. And Passover starts tomorrow night. So it's a very religious week. So you have a lot of people that are off or not participating in this market. It tends to be a quieter week. And you can get these melt-ups that go beyond normal technicals. However, technically, we were due for a little pullback. And I want you to look at this chart. I'll make it bigger for you guys to see it easier. First thing that we
did, here, let me go back full screen real quick.
The first thing we did is we took out the downtrend, right? Look at that. We took out this downtrend from the beginning of the year. That's fabulous from the highs, pushed up, and we're still well off the 8-day. The 8-day is down at 403. We're trading at 408. We could pull back and touch the 8-day and do absolutely no damage to this market. But if you want to go out there and say the world's ending, you can. And, I don't know. Nobody knows for sure what's going to happen here, but it's a very light volume day today. There's not like any big volume on the S&P 500. This is just some profit taking and a much needed breather, in my opinion.
Yeah, and that's what I was talking about earlier too. Like, it doesn't change my overall like sentiment on the market. That we're kind of like going down a little bit. Like at some point, people need to take profits. I don't think it's necessarily like, oh my God, we're switching into like bear market territory here or anything. But it's like when you're so hot, right? You could be talking about an individual stock like Tesla up like 75% over the last 3 months. Eventually, you have to think some people got to come in and take some profits. There's going to be some selling pressure.
It's either that or we're going to get the biggest chase we've seen in a long time. And it's hard to say which one it's going to be here. The Qs put in a new high of the year, right? They've been leading us out of this mess. And I'll show you something else you guys all need to be watching is the VIX. Because, sometimes, why is that not working? Let's go this. Sometimes there's an easier way to do things. That's AB, there we go. So if the VIX gets under 18, I think you're going to see a massive amount of FOMO come into this market in a big chase. And I don't mean a brief break like here where we came down. I'm talking about just pushes down through it with volume all day long and just see that selling going in. 18 has been that big spot that we haven't been able to break on the VIX. And man, I think if we take that out, you're going to see a lot of FOMO in this market. Remember, there's a ton of cash still on the sidelines looking for a place to call home. As you brought out, people are looking to buy bonds. To me, I always go opposite of what retail is doing. When I hear retail investors or somebody saying, oh, I want to get into Bitcoin, well, that game's over, right? That was a clear sign when the taxi cab driver would ask you, what do you think about Bitcoin?
Yeah, that's, I had a taxi driver or Uber driver the other day that was telling me he was deep into Rivian stock and was telling me to buy a bunch of Rivian stock. I didn't really know what to make of it because I was like, I want to hate this, but like, I kind of wouldn't mind owning some Rivian stock for the long term here.
I like Rivian. I think they're well positioned, better to a lot of their peers in terms of the smaller EV plays. And what I mean by that is they're sitting on like almost 13 billion in cash. They're finally starting to get their production lines up. They're starting to get them running. Their deliveries are running way behind. That's part of the problem. But unlike Lucid, which is running low on cash, Rivian seems to be in a good position to get pushing. They still have the backing of Amazon and Ford, and I think this one is actually not a bad one to keep an eye on for for longer term. It just needs to find its wake up point, and it just hasn't found it yet.
Yeah. What about banking stocks, Mike? Have you been looking at FRC, WAL, any of these banking stocks that have been beaten down the past couple weeks?
I am going to make the same statement I've made a couple of times. I've been telling everybody in my service is I would avoid the banks for the most part. If you have to play the banks, I would play the big banks. I would play the the JP Morgans, the Goldman Sachs. Citigroup, by the way, has been incredible. But look at this vicious down candle today on the XLF again, AB. There's put buying all over them today. Big put buying on HBAN came in. To me, these banks are a worry to me. Citigroup's been one of the better ones. Look at the nasty candle we had today here. And if you really want to play the regional ETFs, I think the way to play is through KRE. That's the regional bank ETF, because at least you're not exposed to any one bank directly if more problems occur. And I'll give you an easier way to play it, and I think that is the IWM. The IWM is loaded with these regional banks. They're a huge piece of it. So if you really want some exposure to them, the IWM would be another great place you can go and buy there instead of doing that. I just worry that if you go out and you buy some of these banks and, whether it's an HBAN, right, that continues to get destroyed no matter what, or what is it, FRC?
Yeah, FRC is First Republic.
Right. I mean, look at this. It can't get a bounce. I mean, that's pretty telling to me. When a name can't get a bounce that's been beaten down this badly, there's worry there. That means, big institutions are not screaming for it. There's not much left to go. I mean, to me, it's an avoid. That's just my personal style.
Yeah, I hear you, and I think like from a technical trading standpoint, especially if you're trading on charts a lot like you are, Mike, like you've got to wait for something. You can't just come in and buy like a falling knife that's down 70%. That's setting you up to get burned in the short term.
And it's not just that. We don't know the fundamentals of them yet. Now, what's going to happen in 2 weeks, AB? In 2 weeks we get earnings season starting. The banks lead us, right? So in 2 weeks we start getting a much better idea of what the banking world looks like. But right here, I'm tending to avoid it for now.
Yeah, I don't disagree with that whatsoever. I've personally taken a stab at some of these, just to not FRC or Wall specifically, some of the really beaten up ones, but like a Comerica or some of these other ones that have basically just been dragged down with the other names. I've taken some basically just at a very small but portion of my portfolio I've allocated to them, basically saying okay, here's 3 or 4% of my long-term portfolio in some of these beaten down banking names. And basically my thought process is more well, if I hold them for the long run and they end up being okay, then chances are the stocks appreciate a little bit, and I also pay a nice dividend. So I've taken more of a long-term stab at, again, not some of the super beaten down ones. Well, actually FRC I did take a little bit of stab at, but mostly Comerica, CFR. But it's different what I'm talking about doing, Mike, than trading like what you're talking about.
Well, even investing, I don't mind investing in some of these names, right, and holding them, but I don't completely understand what's going on here right now. I don't think the market completely understands what's going on here, or the banks themselves. And, I think somebody in the room said, on KR said, wait for a bottom though. Bottoms generally present themselves, and you'll see some type of reversal candle, something that comes in and sparks a rally, and you see big volume coming in. And we just haven't been seeing that. In fact, on the banks, I continue to see big put buying across the banks. Bank of America, Citigroup got hammered today, HBAN. I mean, we've seen this over and over again on the banks. So what was it last week? Looking back through my notes here. I can't find it anymore. Went back too far. But, we've been seeing nothing but big put buying on these names. And to me, that is that's a sign that they're still not ready, or there's still some angst out there. So, there's other things to do, right? And right now, after what OPEC did over the weekend, yesterday, this big push up in the energy stocks. Crude is holding up around this 80. If this holds in, I mean, you would go run. They could come running back into these names. So you go to the leaders here. ExxonMobil has been one of the strongest names out there in energy. If you look at it, it's not far from all-time highs. So extended here. Again, you always look at what's going on. How far is it up? Well, it's up huge off the 8-day. So you want to try to let things catch up. But I mean, if this holds in, this looks like it wants all-time highs. You can go back to Chevron, which is one of the best names out there. They're not as strong, but pushing back up. Schlumberger has had a nice big move of late, didn't hold in as well. But you can keep an eye on this sector. There's other places to go, right? And that's the thing always to point out. There's other places to go that have less risk, where you could get a headline that you could always get a headline anywhere, but we know there's headline risk right now in the banks, and that's why I'm trying to avoid it.
Yeah. All right. So what sector? I mean, I know last time you were on, we were talking about the semis, Nvidia, and like they've still been pretty hot. What sectors have you been particularly drawn to?
I mean, I continue to love the strength of the semis, and you got the semis breaking out this range when the market was stuck beforehand. It's still holding up well here. It's hard to say I love Nvidia here. I still love Nvidia. It's a 52-week high now. To me, it's I mean, I said last week. I said I think I posted on Sunday chart 280, then 300 is the next level. I mean, look how it's just elevating itself here, riding the 8-day. It's a pretty chart. You get little dips like this, you look to get into it. The whole sector is waking up. I still cannot tell you for the love of me why Intel is running like this, but Intel is having a week that it hasn't had in over 2 or 3 years. Look at the size of this move in Intel as it's pushing back up here. I wouldn't be chasing it up here. I don't particularly like the name, but the semis overall look good. Micron unfortunately got hit by the China news, and that's a little bit of a problem for them at this point. But overall, I think that's a good sector to keep your eyes on as we go into earnings. And it's hard not to like the big tech names still. I mean, they've all run a lot. They're all looking at these breakout spots. Remember, everybody's like, well, we need to rotate out of big tech. I'm like, well, you can say that, but last year, didn't they beat the hell out of them for the entire year? I mean, didn't last year, Apple was absolutely slaughtered last year, right? All year long, just, every bounce was sold off on it. So why can't these things run back up? Why do they have to come back down? I prefer to buy a dip on them, but I would keep my eyes on the big tech names here because they're still the ones that are leading. Even today, if you look what's the strongest names to be in today, it was Google was up, Microsoft was up, Meta was up. They've all reversed here at this point in the markets, but these were the ones that were strongest today. So, you continue to go where the money is, and that's what I'm looking for. Where's the money? Where's the action at?
Is it possible that, I mean, they let's see, what's the best way to articulate this? I guess that if right now there are renewed recession fears because the Fed's going to keep interest rates higher for longer or whatever, is there an argument to be made that tech stocks are actually a flight to safety in that? Because if you think about, all right, people are going to maybe sell value stocks like oil stocks and companies like Walmart and McDonald's if there's supposed to be a recession. And then, if there is a recession, then the Fed would, essentially have to cut interest rates. So maybe is that a potential reason why tech could be more favorable right now? Or is it to me, it seems confusing thinking about why tech would be favored over some of the other stocks right now, given the overall market environment?
It's a great question, and I think it's specific tech. It's big cap tech, and the reason for that is they have deep pockets. Amazon, Google, Microsoft, Apple, Nvidia, AMD, they are flush with cash. They have tons of deep pockets. They don't need to borrow money necessarily. They float bonds. They're not in trouble. They can survive a recession and float through this. When you look at smaller names like an AI, I don't know their cash level reserves, but a little bit of problematic there. And some of these other names like Roku, which is running lower on cash, and Square after that hit job, they may have to go out and raise cash. It becomes more problematic from smaller tech companies than the big ones, and that's why they're hiding in the big cap. Their safety, to your point, they're safe. They're not going anywhere. They have the means to turn through these downturns, and they've already taken action. Look at how many job cuts we've seen across all these big tech names. Right? They're not wasting time. They're getting out ahead of this. They're laying people off. They're saying we're trimming the fat. We're getting ourselves slim now in case there is a recession. I would also point out that the data. So last month everybody was freaking out because the data came back in, and you and I came on the show. We talked about everybody expects inflation just to go straight down, but it's not. It's going to come down, push up a little bit, right? Just like a stock market, anything else, right? It's going to not go up and down a little bit. So this month the inflation data has been much better. So I think the Fed is close to having the cover to stop hiking if they want to. We'll see. I think you'll get one more rate hike probably in May, and I think they're full of it if they think they're going to be able to maintain these rates for the rest of the year. I think they'll have to cut at some point if the market starts to slip into recession.
Well, I sure hope so, because I know my long-term holdings would appreciate a little bit lower rates right now, because I most of my long-term portfolio is kind of in the tech and more growthy sector. But all right, Mike, we've got a couple minutes left. Do you want to take a look at anything? I mean, I know you mentioned you were looking at snow earlier today. Anything else that you've seen kind of setting up, you know, maybe for an afternoon trade?
Yeah, well, snow I keep an eye on for the rest of the afternoon. So this wasn't on my radar this morning, but they came screaming in for the weekly 165 calls, and we just jumped on it. And you got this nice big move here. It's above the 200-day, and it's trying to break above this range. And you know, you got a gap up here at 161 too, so don't forget that in snow. So I would keep my eyes on this for the next day or two if the market holds in. ON is another name we're keeping our eye on. It broke out today again from this big move and flag. This one's been on fire. It's hard to chase here.
Where's it at now?
It's trading up at 32.30.
Holy cow!
Got over 33 today. You know, but this name has been incredibly strong, and they in general have been rewarding the strong names, and that's where you want to focus on. AI got a hit job today from Kerensdale Capital. So Kerensdale came out, and I read an article a couple of years ago. I'll have to see. I'll send it to you if I can find it. AB, how a lot of these people that put out these short reports, they're not actually short them, but they're actually being paid by other funds to issue these scathing reports to bring the stocks down. I don't know if that's true here or not, but I've seen enough of these short sellers come in and say this. You never hear anything. AI here absolutely destroyed on this. This feels overdone to me. The thing that caught my attention, Kerensdale is saying they reached out to their auditor because they think there's problems with the books, but the auditor is the one that's auditing. We think they would know that. So there's something just doesn't make sense here to me. This seems like a real hit job.
Yeah, that's interesting. Well, I know On is one that we talked about a lot on the show. Of course, that's they make those shoes that it seems like I see them like every single day. More and more people are wearing them. So I've been interested in the stock, but I haven't bought any of the any shares myself.
Jay, earnings in tech stocks were not bad. I think the misnomer here is earnings in tech stocks were earnings in tech stocks were not good. They were good. Guidance was okay. They weren't bad. I mean, I think everybody wants to trade on fundamentals. And the one thing I've learned long ago is markets don't trade on fundamentals very rarely. Unless, you know, most of the time market trades on technicals and on momentum, but not on fundamentals. And, you know, last year we were trading more on fundamentals. We've had a big pullback. A lot of the P&Es of these companies have been slashed down. So the market's looking for growth and looking to make money again. And they're looking for names that are strong. But they don't want these small names. They want the bigger ones, the safety ones. So again, I would stick with those and go from there.
Yep. All right. Well, Mike, thanks again for hopping on the show today. Always a pleasure to have you on and catch up with you. We'll get you on again soon. Next week we're off for the we have our conference down in Florida, but we'll be back the week after that.
Have a good one, guys. Enjoy the conference. Benzinga, be careful, be safe. Everybody enjoy the long weekend.
Woo, you as well, Options Mike. All right, Options Mike on Twitter. Going to go ahead and share that. Sorry, Mike. It sounds like I kind of cut you off there at the end there. But Options Mike on Twitter, at Options Mike, dropping that link in the chat. 12:56 p.m. Let's do a quick market outlook right now. So let's go ahead and pull up that CME watch tool one more time again. So this is coming from CME, going to be basically... So CME's tool takes into account what's going on in the bond market to look at the odds of our next interest rate hike. CME's watch tool is now saying that it is more likely than not there will be no interest rate hike at the next FOMC meeting at the beginning of May. If that happens, that could kick off a new kind of rally in the market. If the Fed's saying, okay, we're going to pause raising interest rates here, we're going to go completely data dependent and look at what's going on with inflation. But this is still a month out, so there's a lot that could happen between now and May, between when the Fed makes this decision on if they raise interest rates again, and if so, by how much. What I would think is right here, and this is just my prediction, is that it's dependent on what the market does. If the market continues to rally from here and we see SPY, the S&P 500 go up to, 4,300, 4,400, boom, forget about it. The Fed is definitely going to raise again. They're going to say, hey, you guys are getting way too ahead of yourselves. If, in contrast, the market stays flat or even falls a little bit from here, I could see the Fed saying, okay, now's the time where we can, pause rates, see what's going on with inflation. Of course, we're going to get some more economic data between now and then in terms of jobs numbers, in terms of some more inflation readings. So it will be interesting. But basically, if you're out there trading, if you're out there investing, this will be the next big thing you have to mark your calendars for. May 3rd, coming up in about a month. My prediction is that the Fed does not raise interest rates. We stay at this current target rate of 4.75 to 5%. And again, I would think the market likes that, and we kick off a new rally from there. But we shall see, because again, that is about a month away, and it is dependent on a lot of things between now and then. As always, guys, thanks for hanging out today. Please smash the like and subscribe to the channel if you have not already. We will be back. So we'll be actually live tomorrow after live trading for a nice little kickoff thing we're doing with Start Engine. And then after that, we should be getting into some regular Benzinga Live programming. So we may do Tuesday, Wednesday for a show this week instead of Tuesday, Thursday. TBD, to be decided. I'll let y'all know. But as always, thanks again for hanging out. Give me a follow on Twitter at AaronBree5 if you're feeling so generous today. I am hitting free follow backs all day. So yeah. And come to Miami next week. Come to Miami if you're cool. Come buy a cannabis. Even if you can't come, buy a cannabis ticket. Buy a ticket to the conference, and then say that you're doing it because of AB, and it'll help me out in my in keeping a job here at Benzinga. So again, love you guys. We'll be back. Peace.